Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm happy to be presenting this week's topic, which is titled Leverage Your Capital to Increase Returns. Now, leverage can be a very powerful tool when it comes to investing. Using leverage allows you to turn a relatively small amount of capital into significant profits. Now, the only way to take advantage of leverage if you're trading stocks or ETFs is to borrow funds from your broker to create a position, which is also known as using a margin account. This is not always preferable or possible for every investor. Now, one of the benefits, among the many, of trading options is they allow you to greatly enhance the power of your capital. My goal in this presentation is to show you how. So the first question is, why trade options? Now, whenever I ask myself an investment-related question that starts with why, my first thoughts go to the 7 secrets of making money with VectorVest. This presentation was created by our founder and mentor, Dr. Bartolito, a long time ago, and I've had the privilege of watching him present this many times. In fact, the latest iteration was presented by my colleague, Mr. Steve Chappell, back on 12/27 of 2019. And if you go into the VectorVest program and click on the Views tab, choose Strategy of the Week in the upper left-hand corner and scroll down, you can watch that great presentation that Steve gave on that evening. And when I go back to the 7 secrets, the secret I focus on is secret number 5. The 5th secret is learn to trade options. Dr. Dolito talked about what options can be used for and the versatility and flexibility that they afford us. Number 1 is to provide leverage, which I'm going to speak about in this presentation. You can reduce risk, lower costs, you can generate income, and you can increase alternatives, again, which is the beauty of the flexibility and versatility of options. But they must be used properly to be able to do these things. A lot of people, when they start trying to learn options, get intimidated by all of the terms. You hear things like delta and theta, straddles and strangles, and it can become overwhelming. You feel like there's too much information and that only the experts can do it. Well, it's simply not true, because once you can grasp the concept that there are only 2 types of options, there are call options and put options, and there are buyers and there are sellers. You can buy a call or sell a call, buy a put or sell a put. Once we understand that, we can understand the foundation of the most complex option trades that are out there. And this layout is a good introduction. Again, I said there are 2 types of options, calls and puts. And there are buyers and there are sellers. Let's start in the upper right corner here, and we'll talk about the buyer of a call option. Now, when you're a buyer of an option, you have rights. You pay money out, and for that debit that you pay, you receive the right to buy 100 shares of a stock at a certain price by a certain date. Option contract is just that. It's a contract with strictly defined terms and conditions. Those terms and conditions are that certain price by a certain date. It's the strike price and the expiration date. Now remember, options are also a security and they trade just like a stock or an ETF. There's a bid price and an ask price. There's a market maker who is tasked with providing a fair and orderly market. And so the contract is also a security and trades just like a stock. So as the buyer of the call option, I have the right to buy 100 shares of a stock at a certain price by a certain date. The seller of a call option has the obligation to sell or provide 100 shares of a stock at a certain price by a certain date. The seller gets paid. He receives a premium, but he doesn't get paid for nothing. And so he is obligated to supply those stocks if the situation requires him to. Now on the put side, the buyer of a put option has the right to sell 100 shares of a stock at a certain price by a certain date. It's where the put comes from. They have the right to put the stock to someone else. And then finally, the seller of a put option, again, gets paid but takes on obligations. So they're obligated to buy 100 shares of stock at a certain price by a certain date. If we break these trades down, we have the bullish side of these trades. If you're the buyer of a call and you're buying the right to buy, or you're selling a put and you're obligated to buy, well then you better be bullish on the underlying market and the underlying stock. Conversely, if you're the seller of a call and are obligated to sell, or have the right to sell, these would be characterized as bearish trades. So those are just a couple of quick definitions and terminology on calls and puts. Let's go ahead and talk about using leverage to profit in a rising market. Let's start by comparing something we're all familiar with, which is buying a stock. And then we'll compare that to an option trade on the same stock at the same time. Our example is going to be Facebook. Now I went back to April the 6th where we had a DEW timing system to the upside. So the underlying market indicated a bullish trend and we went and found a good quality stock. Facebook was trading at 165. Now how much would it cost to buy just 100 shares of Facebook? Well, we know that 165 times 100 is going to cost us $16,500 to purchase 100 shares. We have a table here we call the what if chart. We'll look at the stock price on the left and we'll break down the trade. $16,500 is our initial cost. Well, what if we decided to sell our 100 shares right at 165? Our profit and loss would be zero and we would recoup our $16,500. If the stock went down 5 points, we would be down $500. If it went down 10 points, we'd be down $1,000. All basic things you guys are already familiar with. If the stock went up 5 points, we'd make $500 and so on and so forth. Okay. Our max profit in owning the stock would theoretically be unlimited, right? The stock could go to infinity and beyond and we'd have an unlimited profit potential. But our max risk here is the initial cost, which would be $16,500. So now let's discuss what this would look like as an option trade, specifically buying a call. So again, we're back to our Facebook example on April the 6th. We're bullish on the underlying market and on Facebook, and it's trading at 165. So instead of buying the stock, I want to buy the right to buy Facebook at $165 per share. So I would go out and buy one call option, again, which gives me the right to buy 100 shares of Facebook at $165. That's that certain price. In this case, I used the June monthly expiration, which is the expiration date, and that's that certain date. So that's our setup for buying the Facebook call option. That call option costs $12.25 per share, or $1,225 for the one contract, or the control over that 100 shares of Facebook. So to continue our example, on April 6th, Facebook closed at 165.55. These are the closing prices I'll use for our illustration here. Just 30 days into the trade, on May the 6th, Facebook closed at 208.47. That's a 22.5% gain. By aligning the trade, the stock trade, with the market trend and finding a good quality stock, that's a wonderful gain, almost 23%. I think we'd all be happy to have been able to place that trade and realize that profit. Now also on May the 6th, the Facebook June 165 call option closed at a price of $46.60. That's just a month later into this trade. Let's see what that looks like on our comparison chart. Well, if we look at the Facebook trade of 100 shares, again, we paid in this case, $16,555. On May 6th, at the close, the value of that position was $20,847, which netted us $42.92 in profits, or a 22.59% gain. Well, what if we had bought the contract instead? One contract of Facebook cost us $1,225, as we noted earlier. The value of that option position on the 6th of May would have been $4,660 with a $3,435 profit. Now, here's the key. That's a 280.4% return on our initial investment. Now, yes, for the one contract, the profit is a bit lower, but of course, so is our capital outlay as well. Now let's take it to the next step. What if you'd gone out and bought 3 contracts? Using the power of leverage, I can control 300 shares now at a fraction of the cost of buying the stock. In this case, the value on May the 6th would have been $13,980. That's a profit of $10,305, or again, a 280% return on investment. I've more than doubled my profit there. How about 5 contracts? Still just a fraction of the price, a $17,000 profit with just a fraction of the capital outlay. Now I've taken us into the VectorVest Options Pro software to a section called Options Replay, and this is just a trade simulation of the trade I just showed you on the chart. And we've got the particulars laid out here. We bought that one contract. It was the June 19 expiration, the 165 strike, and we paid $12.25 for it. That's the trade we placed right here back on April the 6th. This trade simulation first will show us, had we held it to expiration on just the one contract, we would have profited $6,000 on the trade. That would have been a wonderful return, but we use trade management techniques that more likely would have had us out somewhere around that May 6th area, where again, had we held it just that first 30 days, we would have had roughly that $3,400, $3,500 profit just a month into the trade. And as I showed on the chart, we can make that 3 contracts. What would it look like with 3 contracts? Well, again, on that May 6th, we would have profited again up to roughly that $10,000 area, $10,300, just a month in. Had you held it to expiration on this particular trade, you were looking at more like $18,000. So that's the power of leverage to profit in a rising market using a good quality stock that's rising in price. Let's go ahead and take a look at using leverage to profit in a falling market. And here I'm going to use the SPY, which is the ETF that tracks the S&P 500. And I'm going to use this as our example to profit in a downtrending market. Now on February the 24th of 2020, our DEW timing system, the signal went to a down situation. Now that's a good time to place a put option on the SPY. Now whether it is to profit in a downtrending market or to put an insurance policy on your overall portfolio, either way we're able to recognize that downtrend in the market. And in this case I'm using the SPY, but you could do it on individual stocks just as easily to profit in that downtrend. Now we buy that one SPY March 322 put at $7.56 per share. That was an at-the-money put. That's roughly right where the SPY was trading on February 24th. If you bought just one SPY put, it would have cost you $756 to buy one contract. On March 20th, which was the expiration date of that contract, that March 322 put is now trading at $88.89 per share. Now I'm not implying that you would have bought it on that date, although that was the signal to buy somewhere right in this range. And I'm not saying you would have definitely held it to expiration. Our risk management techniques would have had you taking a profit somewhere in here, but the point is you would have profited in that downtrending market. In fact, had you held it to expiration, that profit would have been $8,100 on that $750 investment. That's over 1,000% return on investment. And I have a similar shot here in our Options Pro software, again, to give the trade simulation there and show you that on, again, February 24th, we bought the one SPY 322 put option. And here is that trade laid out here at $7.56 is the price I use. That's the closing price for the illustration. At expiration, for that one contract, roughly $8,300 return on investment. Our risk management techniques most likely would have had us out a bit earlier with a very nice return on the downside. And again, we can up the contracts. What if you did just 3 contracts? And that's how you use the power of low cost, low risk leverage to profit in both an up and down market. So would you like to have more leverage without using margin? Would you like to have that low capital, low risk way of profiting in a rising and falling market? Well, if you would like to have a process that would allow you to do that, I'd ask you to stick around for just a few more minutes, and I'd like to introduce you to the Options Jumpstarter course, 6 weeks to profitable options trading. It's a complete step-by-step system that shows you how to buy calls and puts, again, to profit in both up and down markets. We'll take you by the hand and guide you through the exact step-by-step option profit system that you need so you can leverage your money with options. Now, the outcome of this course is that in the next 6 weeks, you'll be able to confidently find, set up, and manage the right option trade at the right time to make money, again, whether the market's going up or down. If you're new to options or have struggled with them in the past, this is the course for you. We put this course together for people who want a system to trade options the right way. Because you have to know that your system or your process will determine your success. So the main things you need to know is when to trade, what stock and what option candidate to trade, and how to manage that trade once you're in. So the easiest way for me to explain it is to kind of map it out for you here, and I'll go through each module. The 6 modules begin with the option foundation builder. It's so important because a lot of people try to learn options and they get frustrated by all the terms and they focus on the wrong things. Now the outcome here is that you get complete clarity on how options work. It's a clear, easy to understand framework. You'll know how calls and puts work, and you'll know which terms to pay attention to and which to ignore so that you don't waste time or get frustrated. Module 2 is all about the trade you need to know to generate profits in an up market, and that is the call option. It's important because you want to take advantage of those explosive moves because they can really make your year, as we've seen in this volatile market. If you're aligned with the proper market trend, the returns can be amazing. Now the outcome of this module is you'll learn the exact signals to look for to identify those market trends and know when the best time to trade calls are. And we'll give you a very specific set of rules for setting up that trade. Module 3 is similar to Module 2, but it sets you up for profits when the market moves to the downside. Okay, this one's important because during down markets, a lot of people get frustrated or angry because their portfolio stalls, they give back gains, and they're not sure how to profit in that downtrending market. Module 4 is all about trade selection. It's important because you don't want to just place option trade on just any stock. You want to have that stock aligned with the market and have great options available, whether it's in an uptrending market to find a good quality stock or finding a crummy stock in a downtrending market. Right? And here we'll show you how to do that. All of those are important, but maybe none as important as trade management, where you learn to prepare yourself for what could happen after you place the trade. Okay, the outcome here is that you'll have a game plan in place prior to placing your trades so that you'll know when to exit, whether the trade goes in your favor or if it goes against you. Then finally in Module 6, it's time to get ready to place your trades. A lot of folks will learn the theory of option trading, but then have no idea how to actually enter the trade with their broker. And if you don't know how to do this, you can go out and place option trades and make a mistake and it can mess up the order. That's not a good thing. So the outcome here is that we'll show you how to place orders to enter and exit your trades, and we'll create this checklist for you so that you can set up and place your trades confidently. So by the time we're done, you'll have that straight line system that we talked about to use options to profit in both an up and down market. Now, in addition to the course modules, you also get a few bonuses. The first one is covered calls for income. We'll show you how to generate a consistent, safe, steady income on a weekly basis using the most commonly used option income trade, the most popular trade called the covered call. We'll show you how to get paid to own your stocks, and you can profit even when the market moves sideways or even if it falls a little bit, selling covered calls. Next, my favorite part are the 6 live mastery support sessions. These live sessions are designed to help you actually implement the things you learn in the course. And don't worry, if you can't make those sessions, you'll be able to submit your questions ahead of time through a dedicated email, and you'll have access to the recording of the live session later that day. So if you order before Monday, September 7th at 5 p.m., we have a special price of just $4.95 for what we call the Mastery Package. We have a self-study package at $2.95. The difference is in the Mastery Package. You get those live bonus modules taught with Q&A sessions, as well as the live mastery support sessions to go over the original modules there. So you can go to VectorVest.com/jumpstart to bring you to the order page. If you're considering ordering, remember when you're in the markets and you hit the enter button, there's no such thing as a risk-free trade. But this kind of is because we offer a money-back guarantee. If after the course you show you've done the work and you're still not satisfied, we'll gladly give you a refund. So you may want to ask yourself, what will it cost you if you do nothing? How much money will you lose by trading options incorrectly? How much potential profit will you miss out on because you don't know how to use options the right way? And then ask yourself, how might life be different if I do this and it works? So remember, there's a money back guarantee, and if you order before Monday, September 7th at 5 p.m., you'll get our special price of $4.95. For the full options jumpstarter course, you'll have 1 year access to the digital course. Right, 1 full year, so after the 6 weeks, you still have access for a full year. Go to vectorvest.com/jumpstart, and I look forward to seeing you at the Options Jumpstarter course. Thank you all for taking the time. Please stay safe and healthy, and I look forward to speaking with you soon.